In this video, I'm going to be going over 3 plays that are going through a bit of a dip right now, and all of them for very different reasons, which I'm going to explain in depth in the individual sections of the companies. But right now, we have the markets cruising to all-time highs almost every single day. But I think what a lot of people tend to focus on is the AI side of the market. And I mean, I really don't publish many videos on this segment of the market. I know it would actually, I'm almost certain it would result in much higher views in terms of channel, probably subscribers, things like that. But there's probably 500 other channels on YouTube where you can find these stocks that are hot right now. I'd instead rather focus on areas of the market that are being ignored at this point in time, because I would argue that the vast majority of my money made over my investment career, 16 plus years going on now, has been finding opportunities in the ignored sections of the market. I mean, very recent examples of this would be Aritzia, which I ended up buying on inventory fears back in 2023. Toromont Industries, which would have been a company that I kind of identified when it hits a certain valuation multiple, it tends to run up from that multiple, and it ended up doing so. And then obviously we have Alphabet back when everybody absolutely hated this stock. GPT was going to eat its lunch. It really didn't. It ended up posting strong returns. I mean, ultimately, you have 2 options. You can follow the herd in terms of AI stocks. You can buy high valuation multiple AI stocks that really need to execute perfectly over the next while here to provide any sort of reasonable level of returns, especially at today's valuations. Or you can kind of do a bit more digging and dig into the, deeper areas of the market where there's a lot of companies that are performing exceptionally well, but are just being ignored right now. And as always, everybody, if you want to get every single move I make, my model portfolio is the private Discord where I'm, announcing all my moves, the trends I'm seeing, weekly newsletter, things like that. You can grab premium for 99 cents down in the description, and I hope to see you inside the platform. Hop on the Discord, say hi. But let's dive right into the video with the first stock, which is Constellation Software. So Constellation Software has been one of the best performing tech stocks in North America. It has crushed most of the Mag 7 over the years. If you had invested $10,000 in this company during its 2006 IPO, you would have $2.9 million today. And that is with it going through the largest drawdown since its IPO. And Constellation's drawdown primarily is due to uncertainty. As I had mentioned, every one of these stocks is drawing down for a little bit different reason. Constellation's is definitely potential headwinds in the future, but I say potential and I emphasize potential because right now we're not really seeing any sort of disruption, but the market has absolutely hammered this company in terms of valuation multiples. So Constellation Software is a company that acquires hundreds of vertical market software companies, and VMS companies are just those that satisfy a very particular niche or industry. They work with governments, healthcare companies, dealership networks, things like that, and they provide very niche software that is effectively mission critical for those companies to operate. So a horizontal piece of software, let's just think of something like Office 365, which satisfies a large area of the market, but doesn't necessarily niche down to provide those very specific elements of a company. Constellation Software acquires and develops companies that do this. They are hyper concentrated on companies that just need a little bit more when it comes to operations. So there's 2 main headwinds here, and I'm going to not necessarily debunk them, but kind of give my bullish case on them moving forward. The first one being AI-related coding. So there's a lot of fears right now that Constellation Software's expertise and underlying companies, that clients might decide that they want to go on their own and develop their own AI platforms. And on the surface, this looks like a risk, but it is much, much more complex than this. First off, these platforms are written in tens of millions of lines of code, and AI can develop this code. Yes, you could go on AI and what they call vibe code, some sort of system that could effectively do something for your company. However, what AI is not very good at now is debugging. So you can imagine a mission critical piece of software. If it does not work, your company will not function the way it should be, and you're going to depend on an in-house AI coding team to develop this piece of software. And then when it has bugs, what exactly are you going to do? Are you going to be able to solve those bugs through AI? Highly likely that you are not going to be able to, and you're going to end up in a big mess. You're going to end up in added operational expenses. You're going to end up in lost revenue. So I just don't really think this is going to be as cut and dry as it seems, but the market really punished this stock in regards to this. AI is not good at debugging. There is client relationships that Constellation has built out. When a company has a problem with a piece of software, at this point in time, they're not using GPT to fix it. They just aren't. Governments, healthcare companies, they're not just going to AI to kind of wholesale their software needs. They're going to still utilize Constellation Software. Now, the second headwind would be Mark Leonard's resignation. And yes, this is an issue. This is a founder-led company. And whenever you get the founder of that company to go away, obviously it creates a lot of issues. We've seen this with Berkshire Hathaway with Warren Buffett. Obviously, he wasn't founder-led, but he was the backbone of that company. But Constellation runs a largely decentralized model, which means that once it acquires companies, the management team stays intact. The company tends to operate independently. So from an operational standpoint, Mark Leonard leaving really won't impact the underlying portfolio of companies it has right now. What it will impact is potential mergers and acquisitions. But the thing here is, we have a lot of continuity in terms of the replacement. Mark Miller, who is replacing Mark Leonard, has been with the company for pretty much since its inception. He was part of one of the first companies that Constellation ever acquired. So you have a guy who has been involved in the M&A process for a very long time, and you also have Mark Leonard sitting on the board still. Now, his health will dictate how long that happens for, but ultimately, I really think this is going to be a pretty easy passing of the baton, and I don't really think you're going to see a lot more inefficiency in terms of capital spend. This management team knows how to acquire, and yes, the poster boy, I guess, of the company has left, but he's not gone, and secondly, there's a very good replacement coming in. Now, the final thing I'll mention is this company is trading at its lowest valuation it has seen since 2021. I mean, if we look to the company's price to free cash flow ratio, it's currently trading at 26x. And if we look to 5-year averages, it is 30.7. So the company is now trading at a, double-digit discount to historical averages over the last 5 years. Now, you could look to the 10-year median at 27x and think that the discount is smaller, but the only thing here is Constellation has become much more efficient today over the last half decade, you could say, at deploying capital. It has made better acquisitions. It's made larger volumes of acquisitions. So I tend to focus more so on this 5-year multiple. And as mentioned, if we look to the historical price to free cash flow chart, I mean, we're looking here 26x. You would have to go back to pretty much, mid 2021 to get those prices again. This company used to trade at 42x free cash flows back in 2024. You can see this large peak in the chart here. The market has punished this company. It is re-rated its price to free cash flow multiple by 38% over the course of a year or so here, based off headwinds that are potentially there but really haven't occurred yet. So the next company is Dollarama, and this drawdown is one that I would view is sentiment based. Defensive holdings generally do not perform very well during this type of environment. I mean, I've been adding defensive holdings into my portfolio a bit more aggressively than growth holdings right now, just because of how frothy the market environment is. And again, this is a situation where I tend to like to zig while everybody else zags, I guess you could say. I do like to accumulate these holdings when they're drawing down. And I do believe Dollarama is one of those companies right now because operations really haven't been impacted all that much. Now, one could argue that defensive discount-based holdings have been one of the best opportunities on the TSX in a very long time. I mean, we have a massive cost of living crisis here in Canada. There's absolutely no question about that. Wages are flatlining. The economy is terrible. Housing is skyrocketing. I mean, people simply cannot afford to live here. I mean, it is a difficulty that is present in a lot of Canadians, and it's really a sad situation. But these discount level retailers are certainly taking advantage of it. Now, over at Premium, I decided to go with Loblaws to take advantage of this opportunity over the last while, and it has edged out Dollarama over the last half decade, just minor amounts, and it's primarily due to Dollarama's, drawdown over the last while. But both of these companies have been absolutely outstanding plays on the middle class and the even upper class like continuing to go discount level purchases because everything costs so much money here. When the market is very risk on, AI names are seeing crazy amounts of money flood in. Defensive names will draw down. So in my opinion, Dollarama is the best dollar store operator in North America, and it's not even close. I mean, if we come here to key stats, we head down to their operating margins, 25%. I mean, retailers, very few retailers, defensive retailers, have operating margins of 25+%. But the one key thing you're going to notice here is when we compare it to a company like Dollar Tree, this is where the results get very different. Dollar Tree does not have the operating margins that Dollarama does. If we come here to the chart, we can see that Dollarama sits around 25%. Dollar Tree is 6.7%. And what this ends up leading to is if we look to free cash flow, we can see that Dollarama, despite revenue being around, 1/4 that of Dollar Tree, it generates around half the free cash flow. So if we were to go on a constant currency basis, it would generate about half the free cash flow of Dollar Tree, but it generates, 1/4 of the revenue. So we can see how profitable this company is over and above other dollar stores. And when we think of the trajectory this company is going on right now, it just acquired the Reject Shop in Australia. This should give it exposure to, I believe it's around 400 stores in Australia with plenty of room to scale. And it's also planning a pilot project in Mexico where it is going to start expanding stores there. So what is the key thing for Dollarama right now? It needs to take its Canadian business model, which has worked outstanding over the last while. It needs to take that Canadian business model and it needs to translate that into expansion in other countries. And if it can do this, there is plenty of tailwinds left for a company like Dollarama. So when we look at valuations, you're going to notice that this company is certainly not cheap. I mean, we're looking at 39x trailing earnings. We're looking at 33.6 forward, and we're looking at around 37x free cash flow. And what you're going to notice is 5-year median averages, they're 27.8. When we extend it out to 10-year, we're looking at 32. So we are higher. This company is dipping, but I guess you wouldn't say it's cheap. But the only thing here is the business has improved dramatically, and the total addressable market that Dollarama is now exposed to in regards to Australia, Mexico, the continued tailwinds here in Canada, I do believe the valuation is somewhat justified. And if we're thinking that 38x is expensive, I mean, we can go to a chart here. We can see that back in 2018, Dollarama traded for about 38x trailing 12-month earnings. And if we go to total returns here since 2018, I mean, if we go to a pricing perspective, we're looking at a share price of around $52 in 2018, and we're going up to 186 now. So the last time you paid 38x trailing 12-month earnings for Dollarama, you ended up outperforming the market overall. So I do believe that the market is generally efficient at pricing in the moats these companies have and just the overall stability. So this type of valuation really doesn't concern me all that much anymore. It's the execution that matters for Dollarama, and they have done so thus far, and I do expect them to do so moving forward. So the third one I'm going to talk about is CP Rail, and you could argue that this one isn't really dipping all that much. I mean, if we look to a chart here, its price has effectively been flat since 2022. However, this one, we have Constellation drawing down due to the headwinds, Dollarama drawing down due to the sentiment overall. I do believe that CP Rail's drawdown is just primarily due to cyclicality. Obviously, the railways are cyclical. When freight is doing well, they're going to do well. And when freight is soft, they're not going to do all that well. So obviously, we had a big run up, as we can see here, over the course of the pandemic. Freight activity was through the roof because of lockdowns, things like that. And now we just have a little bit of consolidation over the last while because freight activity has not been that good. The company's acquisition of Kansas City Southern makes it the first railway with just a single line connection from Canada to Mexico. So what this means is the company could effectively, if it wanted to, get a piece of freight from Canada down to Mexico without having to switch tracks, switch railways, things like that. There's no other railway that has this interconnected country to country across North America. So this does give the company an edge. Obviously, we're seeing a bit of uncertainty in this regard because tariffs are kind of, hurting this element. But over the long term, this should be a very good thing for CP Rail and does give it a bit of an edge in terms of its competition, because if it does want to get stuff from, say, Canada to Mexico, it's going to be able to do so more efficiently, which should drive higher margins and more profits. Now, one could argue right now we are in one of the worst freight recessions we've seen in a very long time. I mean, we've seen it from a company like CN Rail. We've seen it even more so from a company like TFI International, because the railways are somewhat sheltered by commodity-based movements, whereas a company like TFI is more so on that commercial, like less than truckload shipping, and consumers are really slowing down. But I don't really think the freight environment is going to be as bad as it is right now, indefinitely into the future. So when we look to a company like CP Rail that is becoming much more efficient at what it is doing. So it's rail cars, they're getting heavier, however, they're traveling at faster speeds and they're getting better fuel efficiency. When freight picks back up, when volumes pick back up, a lot of people, or a lot of customers, you could say, clients, businesses, don't really have a choice but to ship through the railways. So there's an element of pricing power there, and there's an element that because of the efficiencies that CP Rail has made today, it will eventually turn into a tailwind when freight activity picks back up. This is one of the longest flat durations I've seen out of the railways for quite some time. Again, I've been doing this since 2009. I don't know if I've seen CP Rail trade flat for the better part of 3+ years. So I do believe there is an opportunity there, because the freight environment, as I had mentioned, it will improve. The feds are going to lower rates in the US to kind of pick back up consumer activity. Here in Canada, we're seeing a little bit of a rebound. Obviously, we have much lower policy rates, and eventually consumers are going to open up their wallets again, which ultimately should bode well for intermodal shipping and just overall, automobile shipping, things like that. So the cyclical stocks, often the best times to accumulate them are when it feels the worst to accumulate them. So I'm seeing a lot of people dunk on the railways extensively. And, generally when this is the case, it does prove to be the best time to accumulate these companies. Now, the only other thing I want to quickly relay is the capital allocation from CP Rail. So as I had mentioned in a previous video, the economic moat that a company has is generally just priced in by the market. There's no insider information. You're not gaining an edge by buying a company that has a strong economic moat. But where you will gain an edge is identifying management teams that can flex that moat and continue to grow at a strong pace. And if I show you this chart here, this is a prime example of why I prefer CP Rail much more than CN Rail. So I did own CN Rail, and this chart is pretty much why I sold. The company spent over and above what it was bringing in terms of free cash flow on buybacks and on dividends throughout the course of the pandemic. When the freight environment was through the roof, the company was at peak prices due to, heightened volumes. It spent all its money on buybacks during this time. And now that the company is struggling, now that the company is going through a bit of a freight recession, it doesn't have that capital to buy back shares. It doesn't have that, cash storage to dump into buybacks at low prices. Instead, it blew all the money at high prices. And now you see it scaling buybacks down. Whereas a company like CP Rail, we can see here that it ceased buybacks and it ceased dividend growth through the higher freight environment, primarily because of the acquisition of Kansas City Southern. But now that we see that the company has got their balance sheet in order a bit, we're seeing heightened buybacks at lower prices. I don't think investors truly realize how important buybacks are in terms of pricing. And this is precisely why, if you look to a chart here, none of the rails have blown it out of the water, so to speak, but CP Rail has absolutely crushed the performance of CN Rail over, the last while here. And I do believe it is because management has been much smarter. Now, the final thing I'll talk about is valuation. We're getting a double-digit discount to historical averages. We can see it's trading at 21.3x earnings, whereas over the last 5 years, it's trading at around 25x. Now, if we looked at 10-year median averages, we're looking at 21. However, I'm more so leaning towards this 5-year average, primarily because of the Kansas City Southern acquisition. I do believe this company is going to be able to grow at a faster pace than it has historically. So I tend to lean towards this multiple in terms of, the discount to what you were paying historically over the last while. And if we look to price to free cash flow, it is actually trading at a larger discount on a 5-year basis, and it's still a discount on a 10-year basis. So CP Rail has not been this cheap for 5+ years. So if we can look to valuations, we're seeing, pretty much back to 2020, where, you were getting this railway for 20x earnings, and it has grown earnings per share at a 25% pace over that 5-year time period. Now, you might think that, 25% earnings growth over a half-decade time period, it really isn't all that good. But when you consider the freight environment and you consider the fact that freight is eventually going to rebound here, I actually think that a 25% earnings growth over a half-decade period of a very rough environment, I actually think this is a good thing. And when freight does resume, volumes pick up, things like that, I do believe it's going to be able to grow at a faster pace than it has over the last half decade here, and the market will ultimately end up rewarding it. So there you have it, 3 companies. I really think this video kind of highlighted 3 companies drawing down for very different reasons. These are certainly 3 blue chip companies in the country. One facing some headwinds in Constellation, Dollarama, that sentiment level, that defensive nature that are seeing some outflows right now. And then CP Rail, we have the cyclical lows. When the markets are soaring like this, when we're seeing plenty of, influencers on social media, wherever it may be, posting massive returns, obviously it seems a bit counterintuitive to kind of go where the herd is not going, but generally this is what provides the best returns moving forward. AI stocks are priced to perfection. I'm not saying perfection could not occur, but generally the higher you pay today for a stock or an index, whatever it may be, the lower your future expected returns can be, just because a lot of that forward growth is already priced in. Whereas if we look to ignored parts of the market, we can tend to find a lot of opportunities. I mean, I've done so for a long time, pretty much the entirety of my investing career, and I will continue to do so. And at some point, the markets will shift from high beta plays into stability and cash flow generation. It will revert back to the fundamentals. When that happens, very difficult to say, which is why I still do hold some exposure to the AI side of the market. I own plenty of AI related stocks, but a lot of my buys over recent times have shifted into these types of companies. And as always, if you want to know what I'm doing on a weekly basis, you want that newsletter, you want to hop in the Discord, model portfolios, my custom stock screener, you can grab premium for 99 cents. I'm so confident you're going to find massive value in the platform that I am willing to give you it for $1. So head down below the description, grab that offer before we close it down, and we'll see you next time for more great Canadian content.